I don't know. This is that weird week where everyone's like, oh, tequila, let's drink too much tequila. And I'm like, well, you don't have to wait for,
Yeah, I mean, you get
those
the
of you
whole
who don't
year
know
to do
Cinco
it.
de Mayo to drink too much tequila. And it's one of those things which is like, guys, like,
Yeah.
if you like tequila, go enjoy it on a different day. Don't just drink your entire year's allocation in one night.
I'm literally just like, it's like me and St. Patty's Day. I drink Irish whiskey all year round, and I also drink quite a bit of it on St. Patty's Day too.
Exactly.
You can drink Irish whiskey on 318 and 319, and you can even drink it on 320.
You can drink it on St. Patrick's Day. You can drink it on St. Practice Day.
Yeah, and every day in between.
Well, every day in between is St. Practice Day.
Did you know that over $5 trillion exchanges hands on a daily basis? That's an average of over $220 billion an hour. Now, how does this much money move every single day, and why does it move the way it does? Here on Drunkenomics, two bartenders who also happen to be students at the University of Nebraska Graduate School of Business are going to sit down and drink to the global economy and try and translate it into English. So sit back, relax, pour yourself a stiff one, and have a drink with us to the comedy that is the global economy. And welcome back to yet another presentation of Drunkenomics. This is the drinking podcast with an economics problem, and regrettably, I would like to welcome us back as the more gracious host. Less gracious host. Wow, I butchered it already.
I'm sure you'd like to welcome us back as the more gracious host, but alas, the VIX won't allow it.
It's only because I could tell you're exhausted, and I want to take the burden from your hands. I want to be the more gracious host for just 1 week, please, just 1 week. But once again, it's not happening.
I'll be honest, I want that for you too.
I know, and I want it for you to be the less gracious host. Walk a mile in my shoes. Know what it's like.
Well, no, right now I am walking a mile in your shoes, and you're walking a mile in my flip flops, and so it's definitely getting a little weird.
Yeah, it is getting super weird, but nonetheless, my name is Aaron Wong. So much less gracious than the guy sitting on the other side of the camera in another state. That is Nebraska. And what was your name again?
Well, they call me James Goldwater. Because that's my name. I guess I didn't know where I was going with that one, but it was going to be
I've heard they called you other names before too that aren't as kind. So let's just stick with James Goldwater for now.
Bartender.
Yeah, exactly. So thank you so much for joining us. If it's your first time, welcome. And if it's your more than first time, welcome back. And if you haven't yet, check us out on social media. It's at Drunkenomical, DRUNKENOMICAL on
Facebook, Instagram, Twitter?
Elon Musk's
so both the Twitterverse and potentially the Muskverse soon.
The Muskverse, the Metaverse, whatever it is, it's at Drunkenomical. Find us there. We have some smart alecky tweets. I don't know. I think we're pretty perceptual, but that's just me thinking things.
We have some dumb alecky tweets too, to be fair, and that's I think that's more par for the course.
It very much is.
Golf parlance.
Nice. Yeah, now you're in my neck of the woods. But yeah, check us out there. We also have a LinkedIn page. We post articles every once in a while that I think are pretty good. At least some people in our Discord say it's good. And speaking of our Discord, links to our Discord in all of those bios.
In all those places,
free to all, like Fight Club.
In your first day in the Discord, you have to post something.
Yeah.
New rule.
Speaking of our Discord, we have some cool channels in there. Questions for hosts. You can ask us questions. You can show us what you're drinking, how you're drinking it, who you're drinking it with.
Contribute some advice that is certainly not financial.
Definitely
Or you can just chat with other Drinkonomous econoholics. Just kind of figure out who's who, where. Maybe make some friends while you're at it. Or some frenemies. Up to you. Your call.
Yeah, exactly. And speaking of our not financial advice channel, Tim, by the way, I haven't checked my paper trading account today, but when I put on that trade, what did I do? I forget what I did. I detailed it in this thing. Yeah, okay, so that's what I did. I bought 500 shares of Netflix, got about $217 a share, sold a May 250 calls against it, gave me about 20% upside. So that was actually like 25% upside. So that was my strategy, but it's backfiring against me, man.
Yeah, up just shy of 5% today, so.
Yeah, but I bought in my paper trading account, so full disclosure, paper trading account, and this was well after 3 days after their earnings smackdown that they had. Yeah, that's what happened. So not looking good, but it's only in my paper trading account, so I'm not too worried about it. But yeah, Netflix is at $199.46 is what it closed at today. So so even the covered call, it's not really helping. So
yeah, I was gonna say, like, you're really flirting with that point where the cartoon's like pulling his collar going,
yeah. But speaking of which, a lot of great conversations there. So if you want to check that stuff out, Like I said, free to all.
But yeah, no, it's usually a fun time. It's
Absolutely.
I mean, there's been some follow-on stuff. I mean, I guess I don't really know where to start, but there's been some fun follow-on stuff from last week's episode. One of the things that I was looking at was exactly how much does Tesla have to decline by before the financial institutions that have lent him money, that have lent Elon Musk money, that have essentially the institutions that are holding the pledged shares or to whom the shares are pledged, where they sell, and it's a 40% decline. So not likely to occur, but basically, that means that if you see Tesla getting close to $600, you're going to see the banks and financial institutions start to get really squirrely about whether or not let's put it this way. They're going to start they're going to start playing the options game to try and protect the downside position.
Yeah, exactly. They're going to start using those derivatives to hedge. But I mean, since the whole merger has been even announced, Tesla stock has been taking a beating.
It finished up a little bit today, but yeah, as a whole, it's taken a beating. But when you sell $8 billion worth of shares,
what surprised me was like on Friday, he said he was going to sell $4 billion worth of Tesla,
4.4 or something.
And he said it again on Friday as well, and the stock was up on Friday, which I'm like, how does that make any sense? But okay, it was up for a second, and then everything at the end of Friday, everything tanked. It was up 5% at one point on Friday. So to me, I'm just like, why are there buyers right now when there's $4 billion of this thing being unloaded? And then not to mention another.
Yeah, when you know there's a major sale going on. And I tend to agree with that. That's definitely one of those things where you're like,
And then today it closed up too. So, or no, it didn't close up. It was down for a little bit and it rallied massively like intraday. So I don't know. I don't get it, but I like this question a lot. From Panson once again. We'll come back. Yeah, thanks for chiming in again. He says, if Musk is buying Twitter at $54.20 a share, why is the price not there right now? Could I buy Twitter for whatever the price it is now? I'm paraphrasing a little bit, and then sell it for $54.20 when the transaction goes through.
Well, to the last part, yeah.
Yeah, but you wouldn't actually be selling it. It just basically it just gets taken out of your account because last time I owned a stock for a company that ended up getting gobbled up from an acquisition. It just basically I didn't do anything. It just all of a sudden that share became cash.
Yeah, it's that auto sale.
Yeah. So if you own Twitter, whenever the swing date is, and I don't know how long, it could be a year from now, it could be 2 years from now, it could be God knows when, right? Maybe in 6 months, but whenever the swing date is, it's just automatically, if it passes at 54.20, if once all the T's are crossed and the I's are dotted, if it's still at 54.20, then on that swing date, your Twitter shares will be automatically converted to cash at $54.20 a share. And if you're wondering why isn't the stock at 54.20 right now,
I'll just say some doubt. There's just probably some doubt that people are going, well, this may not happen. This may not actually, term we use during SPACs, but this deal may not actually be consummated. You may just see that it's a lot of talk and then
but it's also, it's also the timeline too. Because what if it takes 5 years, right? Yeah. So if the stock is trading at $50 right now, and it takes 5 years to earn $4.20 a share.
Yeah, why would you buy into that potential hole?
I mean, that's a $4 move for a $50 investment is not a very big return on investment. So maybe that's why too. I mean, there could be several reasons, but the big one is usually just doubt. We don't know if it's going to go through. We don't know if the 54.20 is going to hold up. That's mainly the reason. That's the main reason. But then of course the second one, that's much smaller reason, is the time frame.
Yeah, we don't know when it's going to happen either.
Yeah. And then from there, I like this question a lot, dude, because this was something that we talked about, I think 2 weeks ago. Eric Pike, man, thanks for chiming in. He says, because of Social Security, do you think our federal government wants us to die sooner and faster?
I mean, that's
very, very tough question.
Do they want us to? Real. I'm sure there are some that do. It would be convenient. It would be really convenient for them because it would solve the problem that they don't want to deal with, which is to say that they've got Social Security set at the age of 65 with the expectation that you die at in your early 70s.
Yeah.
And while we have seen that for the first time, during COVID, life expectancy dropped in the U.S. and then again last year. So we are seeing that life expectancy is dropping in the U.S. For the first time in a very long time.
Yeah.
The thing is, there are still more people, and there are more people living longer than Social Security was ever intending to pay. And so it's definitely one of those things where you're like, do they want us to die sooner? I mean,
they won't say they will because they want your vote. But
yeah, what they don't want to do is they don't want to have to sit here and tell you we need to raise the Social Security retirement age to 70,
right?
Because it was never intended to be paying out to someone for potentially 30 years.
Yeah, 40 years.
It was made to pay out for 7.
Right.
7 to 10, and now it's paying out for on average 10. I can't say on average 10, but for 10 plus.
Yeah, because with the life expectancy being at around 75, 78, depending on if you're male or female, and then on top of that, can you imagine that poor sucker that just pays into Social Security his entire life and then kicks the can at 64?
At 65.
Yeah, it's like, okay, so you paid into Social Security all your life and you never reaped the benefit. So I'm kind of back and forth on Social Security because I really feel like the reason why it exists is so that other government programs can borrow from it. I'm 100% sold on that. That's the purpose of Social Security and the fund for Social Security.
It may have been what it's become, but
it's exactly what it's become. And I feel like that's the reason why they want to keep it. And that could be the reason why the answer to Eric's question is yes. So
do they want that to happen? That may not be what they're they may not be sitting here actively thinking like, I want people to die sooner and faster and all that. But what I will say is it is exceptionally convenient for if that were to occur, it's very convenient. And so if they're not actively for it, they're probably not against it.
Yeah, exactly. I mean,
they can
keep borrowing from it. Yeah.
Yeah. Maybe that's my disenchanted view.
Well, either way, it's still a very valuable perspective. I certainly had fun drinking to it.
Maybe this is an accurate perception of just how much the government does or does not care about an individual.
I know, but that's not a secret. I mean, and that's anymore. That's a very popular thing to believe, right? That the government really doesn't care about you. And to be honest with you, I think it's true, right? I don't think the government really cares about you individually. And so, anyways, kind of meandering off of that and going into the actual economics problem side of things, because we have a pretty big economics problem. I'd say it's pretty drastic.
Only one.
Yeah. Okay, so I think should we start by talking about the elephant in the room, which is the 10-year hitting the 3%
mark, 3% yield?
Yeah.
Historically, we've talked about yield, and when yield goes up, what we need to realize is that the coupon payment doesn't change. So the only reason that is the coupon payment becomes more attractive is because you're paying less to buy the right to that coupon payment.
Yeah, right? The par value of a bond is $1,000. If the coupon payment is 2%, that means if the bond is trading at par, that means the yield is 2%. Right, the yield and the coupon are even. That's when it's trading at par. If the bond is trading at $900, obviously that 2% coupon is going to be a what? I can't do math. Let's just call it 3.5% yield.
Yeah,
right?
So it's gonna play out better for you because
because you're paying $900 for 2%.
Of the face value, that par value. So you're $20.
Yeah, $20 every 6 months.
For $900. Hey,
not a bad deal. But bond markets are getting crushed right now. I love this. So last week, Larry Cordiso, I don't even know who this is. I put this quote in here because someone said this on CNBC. They're saying the discount rate for equities is being repriced because the 10-year is hitting 3%. And I felt like that was a really profound thing to say because it's true. Everybody judges the risk premium of equities based on the U.S. 10-year yield.
Yeah, because that's essentially your risk-free rate.
Yeah. So I thought that was a pretty profound thing because it's like all of a sudden, risk premiums are getting compressed. So when that happens, people are like, okay, so what is the fair PE ratio for the S&P 500 with the 10-year yield at 1.3%, but now I think it closed at 2.987%, right? Which is still
that's
still wow, and if you look at the chart from year to date, the 10-year yield, man.
Yeah, if the yield's up, that just means the face value of the bond's down. Yeah, what people are willing to pay for it is down. And so that that shows me people are dumping out of the bond market.
Yeah, but they're not going into equities,
or that people aren't buying at auction.
Oh yeah, I mean, I feel like every time I see a bond auction on TV, like on CNBC, it's just derating. It's like
and
there was only a bid for 60% of the bonds that are being. It's just.
I mean, not unexpected when you view like what the stock market growth of the last 2 to 3 years. And it's one of those things where you're like, oh, well, specifically, I should say the last 2 years. So after March 2020, it's like, okay, stock market's growing like crazy. And then every time it's been in a downturn, the Fed has done something to stabilize. So why go to bonds? Why do you need to go to bonds? Because clearly, even if you have a bad day, a bad 2-3 days, the Fed's going to come in to, tilt the scale back in your favor. So just hold.
Right.
Wait for the Fed to, manipulate the system in your favor.
Yeah. And then on top of that, I don't think the fact that the Fed is going to more than likely raise interest rates by 50 basis points in the next 2 meetings. And then from there, gradually throughout
both meetings too. So
yeah, I don't think that I really don't think that that's helping the bond markets at all. And why would you want to buy a bond right now if you know interest rates are going to continue to go up?
Yeah, which means so as those interest rates go up, you go, well, I could wait 6 months and get a bond that's paying out substantially higher coupon.
Yeah, exactly.
Take it.
So the bonds that are currently out there, obviously, who wants those bonds? Like nobody wants those bonds.
Yeah, think about a 10-year bond that was issued when it was 0 to 25 basis points.
Yeah.
The coupon on that's going to be next to nothing. So the yield on that's going to be skyrocketing right now because as you see interest rates pick up, people are just going to be like, look, I see interest rates going up in the future. I will not buy this low coupon bond from you except at an extremely steep discount.
Yeah. I mean, I'll pay $600 for it, which makes the yield on that bond 3% or whatever. I don't know. I can't do that. I'm not doing the math off the top of my head very well.
Yeah, I don't want to do it.
I know. I don't have Excel in front of me.
No.
Yeah, exactly. And I have a beer in the way, so it's not like I have 2 beers and double fisting. So keyboard's a little bit inaccessible right now for me to do the math.
Exactly.
So apologies in advance. But yeah, I do think because the 10-year yield is rising the way it is, it's hitting this like reset button on equities. Because if the risk-free rate is 3%, like, wouldn't that make you kind of less risk tolerant? Or I'm not asking that correctly.
Less tolerant of risk?
Well, it's the risk premium is compressed. You know what I mean?
That's what I'm saying. It's harder to offset risk when your yield is like that.
Right.
You know what I mean? It's that weird like, oh man, I really have to lever up to offset this risk.
Yeah.
But then you also sit here and go, the Fed's not letting the risk actually be real, so why would I offset it? When I can wait a few weeks and buy a different 10-year bond.
Right.
So one that isn't maturing in 8 years, but one that will be maturing in 10. And it'll cost me more money, but it has more bang in terms of its coupon payment.
Yeah.
So future values in the event of uncertainty, I can dump out of the bond position for cash to people that want to shore up their portfolios. So I could see where that would be.
Well, I guess the way I'm trying to ask it is like, because normally if you go into equities, you want a much larger return than whatever the 10-year
Otherwise, why wouldn't you just go into the 10-year and not worry?
Right, exactly. And then, so if you're going to take on risk, normally you want whatever the risk-free rate is plus 5% or plus 10%. Like you want your risk premium to be
plus something that you decided. So like you decide that you want to like I would say like right now if you're looking at selling, you'd say I want the risk-free rate plus at least inflation.
8%.
Yeah, so it's like if I'm not getting that return, I'm losing money.
Yeah, so if the 10-year rate is at 3%, and then you take in the inflation risk premium, which is 8%, like if you go into equities, you want to beat those two combined. So if you go to equities, you want an 11% return. That's pretty much what that's saying with the 10 years. So I guess that's what I was trying to say that's what I was kind of trying to ask is like, are trading multiples being reassessed because the risk-free rate is so high? And I feel like, that quote by Larry Cordiso.
I think they have to be.
Of course, yeah. So I think they have to be too.
No, that's what he's saying is a discount rate for equities is being repriced, which...
Oh, not the trading multiple, yeah. So I guess let's talk about what the discount rate of equities, what that really means, right? Because I feel like that's more of just like a fundamental thing. Is it more of like a book value calculation or is it?
No, it's like an equity discount rate. So what's always funny is people are like, oh, what equity discount rate? What is that? And I was like, well, you generally don't get to buy equity at a discount ever. I mean, you know what I mean?
No, it's always at a premium, right?
Yeah. So, because someone has it and they're selling you future cash flows, right? Or current cash flows. But so if we really want to talk about the discounted or the equity discount rate, it's used to determine the value of future cash flows, right?
Yeah,
so it's
forecast.
So instead of like a theoretical or a risk-free rate, it's the actual cost of financing.
Oh, okay.
Any activity.
No, I remember this. This is coming back to me.
Debt or equity capital, right? So it's
the next 5 years terminal value discounted back to a dollar value today.
Yeah, it would be the actual discount rate that you're using right now to determine the current value of future cash flow, the present value of future cash flows.
Right. Okay. Yeah. So obviously the discount rate is going to be adjusted massively because it's always
fluctuating.
It's always pegged to a risk premium.
Right. Historically, a number a lot of people would have used is LIBOR.
Right.
And then some other things, right? So
historically, right? That's in the past. But by some metric, it's all. I mean, anytime they try to look for the cost of capital, they always refer to some sort of risk-free rate, and usually it's always the U.S. 10-year, which obviously now because it's going up and it's been so low for so long, artificially low, I would say, for so long that it's just that's screwing up all these discount rates. And I think because of that, the outcome is it's going to affect the trading multiples.
Well, it has to, because as you see it go up, and not a little bit, it's gonna go up a lot. You're gonna suddenly see these numbers that, in order to maintain like the current growth or the current kind of, you're going to see these returns that just become impossible. Where you start to see like, you need to get 33% return to maintain. That's just not likely. It's just very unlikely.
Unless there's like another stimulus round or something like that.
Well, and I'll be honest, looking at the Fed, they're really going the other way on that one.
Yeah. And I think what would really help is if everybody stopped trading NFTs for a second and just, went back to trading stocks. That would definitely help. Or bonds. I'm sorry.
Stop trading JPEGs, you kids.
I know. I could feel your cringe across the camera, but I think this kind of leads into a very good next point, which I think is, the forward multiple on the S&P is now 17.5, which is the lowest it's been. Remember when it was like 24 or something like that?
It's starting to make, to me, it's starting to make sense again.
I still don't think it makes sense yet.
Still high.
It's still very high, but there's still people saying, 5,000, like end of the year, 5,000 SPX. Which I'm like, I'm
more confident than I was when we set our bet.
I know. And right now, if our bet ended today, which we have about 2 months left on the bet, if it ended today, you're winning. So it was like 40. I think it was 4,400.
Yeah, we said 4,400, and that's by what was it, July
17th or something like that.
Yeah, I don't know. I'm less concerned now than I was. There were definitely some points.
Wow.
When we took that bet, and I was like, I know. Maybe no one else is as pessimistic as I am.
Well, I don't know what it was, but I think Black Friday was really when everything started to hit the fan. Across the board, everything hit the fan.
Well, like Black Friday chain woes mean that people don't have anything to sell, so you can't have record numbers if you don't have anything to sell.
Well, speaking of supply chain woes, okay, so the Fed is obviously meeting this week. That's one thing that we definitely need to highlight. In a pretty desperate time, I would say, in our economy, GDP numbers negative.
Well, GDP numbers are negative. GDP growth is negative.
So my bad. GDP is definitely positive, but it's negative period over period. Growth is.
We saw Q1.
So it was down 1.2%. Was it month over month or was it?
I thought it was.
Yeah, so it was Q1, not month over month.
I think it was just Q1.
Oh man, that's not good, man. That's 3 months of negative GDP growth, which is really scary because PCE hits 4-decade high, which I think PCE is more so what the Fed likes to look at when they measure inflation.
Yeah, it is. It's one of their favorite metrics. It's put that way. One of their favorite.
I think the Fed actually likes it a little bit more than CPI, but I don't know. I think they just like the basket of goods in PCE a little bit better.
Yeah, but it makes sense. It would make sense just because it's maybe a slightly more accurate metric of like pain.
Right.
It's not the pain index, but it's that personal consumption. So PCE, guys, the personal consumption expenditure, right?
Yeah.
So it's a lot of it's food, it's energy, it's things.
It's not used cars. That's what it is.
It's not durable goods. It's the things that people have to consume.
Right.
So when you see when inflation hits there, that's when it hits everyone. It's hitting everyone across the board. Now some people are more insulated than others.
Yeah.
But when you start to see food, gas, in the winter, natural gas, in the summer, natural gas
is
gasoline for your car.
Year to date.
You see your energy prices going up when you see food, but you can't not have electricity, you can't not have food. Mm-hmm. When you start to see that inflation going the way it's going in those sectors, then you start to see legitimately the buying power, the buying power
for you and me,
your citizenry decrease, right? So we've historically just kind of dropped the really simple thing, which was if inflation is 6% and you get a 5% raise, you're making less money now than you were last year.
Or you're making less buying power because that's kind of like the way to
more
determine
money,
the currency.
Your money can buy less, so you're not you're doing less well than you had been.
There we go. Yeah, well said. And I think when PCE comes in this hot at a 4-decade high, when CPI, I mean, obviously last month's CPI numbers were not very good as well.
March they were 5.2. 5.2% from the year before. In February, they were at 5.3% from the year before.
Yeah, not good.
So it's core prices are up 0.3% month over month.
Yeah, and we have negative GDP growth. I think there's a word for that.
Well, but high inflation, low or declining GDP growth, it is that.
Bob Dylan, this
stagflation. Oh. Yeah, no, it's stagflation. That's when you start to look at the concept of is it stagflation.
Yeah, that's almost as depressing as that Bob Dylan album.
Which one?
Highway 61. Oh yeah, that's true. It's a good question. Highway 61 was what I was referring to. That's a really sad album. It's a very sad album. Great album. Fantastic album.
Yes.
Very depressing. But it's kind of like that tweet that we tweeted out with
someone
tweeted out inflation at 8.5%, negative 1.2% GDP growth. I swear there's a word for this. And then I tweeted out, hey, I'll give you a hint, and I tweeted a picture of Stag Jr.
because we should all know that the first time stagflation happened in the United States, or the first major time it happened in at least recent history, was the 1970s. So good old Tricky Dicky and the 70s stagflation.
I feel like it's happened before. It's definitely happened before, but that's just when they came up with the word for it.
Yes, and it was a concerted period of time in which it was occurring. It wasn't just like a weird quarter or something, but a prolonged period.
But I feel like stagflation always starts with, go figure, energy prices, right? Because in the 70s there was that whole energy supply shock or whatever it was.
Well, there was a supply in the 70s. There was a supply shock, and there was an energy issue, and there was an oil embargo. Really, oil problems.
I feel like that was the cause for the supply shock. But
it was.
It also could have driven short-term demand through the roof too.
I mean, so what happened in the 70s with Nixon is, I know he put in like wage and price controls in 71 and like late 71.
Doesn't sound like a cool thing for a president to do, but
on top of that, there were still like cost push shocks, right? So there were costs were going up. So you end up at a point where you've got this spiraling prices. So he tries to check it there. And then you get the 73 oil crisis, right? So where OPEC just stopped pumping. Well, they didn't stop pumping, but they really restricted the supply.
Well, and it's kind of like right now, with oil prices jumping through the roof, because oil prices went from 60 to 100 like overnight, right? It was like 2 months for oil really to go from 60 to 100. Obviously, geopolitical tensions in Europe, that didn't help at all.
Well, yeah, you've suddenly got, you've got Poland and there's two European countries that have had their natural gas switched off from Russia. You have a lot of other countries that are, Germany is one that's saying we have to assume that is coming. And so they're trying to source elsewhere. They're trying to the bottleneck in Germany is they don't have a means to bring, even if they could source the material from the United States, which they could, they don't have an ability to get it into Germany at a rate that competes with the pipelines. Right. So it's not like they can, it's like going from like a pressure washer to just a regular hose.
Yeah.
Like it's so like a fire hose to a hose, right? It's like, I'm still getting water, but it is not the same.
Yeah. I mean, I haven't looked at too many instances of stagflation, but I don't know if there's a time where there's a food crisis.
Rare.
Yeah, it's really rare because like what happens is like it's high inflation, negative GDP growth, which usually like when there's high inflation, the Fed knows how to handle that. When there is low GDP growth or negative GDP growth, the Fed knows how to handle that. Normally, one thing leads to another, right? Yeah, when you have, because like usually what happens is like low GDP growth or negative GDP growth leads to like their response to that, the Fed's response to that leads to high inflation. And vice versa, right? So when the Fed responds to high inflation, it compresses GDP growth.
To me, there's kind of it's more of GDP is kind of this. GDP is the output measurement, but it's more you see unemployment and inflation have that inverse relationship. So high unemployment leads to low inflation.
I was looking at it from a backwards point of view, like when you have
they all feed into each other, right? So like when GDP is growing very, very quickly, unemployment goes down because more people are getting hired, more people are getting, and inflation goes up. And then as inflation goes up, you start to see GDP go down. And then as GDP goes down, you start to see unemployment go up. And as the unemployment goes up, you see inflation go down, which then allows GDP to go up, which pulls unemployment down, which pushes inflation up.
So are we seeing a cycle here? I mean, this is the cycle.
Yeah. But stagflation is what happens when you have high unemployment, low GDP growth, and high inflation. So it's one of those things where it's like, it's the tools you have just don't work.
That's why I said, like, what the Fed does to address low GDP growth or negative GDP growth leads to high inflation.
Yeah.
And what they do to address high inflation is what they're trying to do the rest of this year, which is raise interest rates, slow down monetary supply. But what does that do to GDP growth?
It usually does slow GDP growth.
So basically, you get into this period of stagflation. Whenever you're here, you're really just caught in between a rock and a rock, or a hard place and a hard place. I mean, it's just sucks.
Because the tools you're using aren't made for this. And so you end up at a point where it's like you either have to go over the top. And so that's why when you see in like the 70s,
I have no idea what he did in the 70s.
Paul Volcker.
Oh, I know who Paul Volcker is.
So everyone remembers Paul Volcker. So 79 to 87, he was the 12th chair of the Federal Reserve, but he was put in place by Jimmy Carter and was renominated by Ronald Reagan. So he was kind of the original J-Pal. So he's the guy who ended the high levels of inflation at the time. But if you
how long did it take him? It took him at least 4 years, right?
Oh yeah, well remember he only came in 79, right? So he was confirmed.
I thought he came in way earlier than 79, but okay. No, yeah, okay. Now I'm seeing it. Yeah, 79. That's when he came in.
But yeah, he put the hammer to inflation. Like he inflation like in 1980 was nearly 15%, right? And by 83 it was down under 3, right? Because he came in and he just they raised rates, like they put the hammer to borrowers.
Wow.
Because you look at like the Fed funds rate, averaged 11.2% in 1979, and it peaked at 20% in 1981.
Oh, right. Like God, yeah, I'm seeing that. Yeah,
and the prime rate was 21.5% in 81 as well. So it's like and
it averaged 11.2% during his tenure. Looks like.
Yeah, but if you think about it, like this is what led to the recession of the early 80s. Like that is what this did, right?
Yeah.
Unemployment went over 10%. Let's put it this way: he was not a popular man.
Well, at the time, the chairman of the Federal Reserve was the power that person had was still pretty new, relatively speaking.
He was only number 12.
Right. Yeah. But also, we had the gold standard pretty much until like 2 decades before he was doing his thing. Right. So
not even 2 decades.
Or a decade and a half.
The gold standard had only died 6-7 years before.
Wait, really? Oh, wait, that's right. Over. Okay. So I'm so far off in my history right now. I don't know what's going on. I think it's my beer goggles or whatever it is. But yeah, like I feel like at the time it was kind of like, okay, it's up to the Fed now. Apparently,
he sat there and he saw high inflation. And he looked at it as damaging to the economy because high inflation, again, we know is harmful to the worker. But then again, so is high unemployment. Yeah. But he had to make a decision, so he said, okay, we're going to break inflation. Yeah, and he did. Now the problem is it caused a recession.
Well, do we do that now, right? Because right now we're already halfway to a recession.
Well, that's what people are thinking. A lot of people think we are that we're either heading towards it no matter what we do. But right now they're saying we're either heading to it because inflation's out of control, but the Fed can do it too. If the Fed hammers inflation, but that causes a rise in unemployment, that could also lead to
exactly.
It's one of those things where it's like you have 2 mystery drinks that are actually the same thing.
Yeah.
One's hot tequila and dishwater, and the other's dishwater and hot tequila. Like, which one do you want?
Yeah, no. So, I mean, because the thing is, I feel like if you try to, whatever the Fed is trying to do now, I have no idea. And it seems like every week, thank God, nobody from the Fed said anything last week. At least if they did, I didn't hear about it.
If they did, no one reported it.
And because they need to stop reporting it. Like, it's seriously, like if the Fed says something outside of whatever happens this week, if someone tomorrow says, which today is Monday, May 2nd, if someone tomorrow, May 3rd, if James Bullard or whoever it is, Leo Brainerd or whatever says tomorrow, like, oh yeah, no, 50 basis points is too aggressive. Like, just don't even react to it. Don't even react to it.
I agree, and I 100% agree with you. You, as the Fed, you disclose your minutes, and then you do a press conference every meeting, like on your meetings. That should be the official communication. I don't like 100%. When they start trying to telegraph a message out. I'm like, no, do the message. Let the markets legitimately react. Don't sit here and it's like bad misdirection.
Yeah,
just play the game.
Okay. So 1 week Waller says this, and then Bullard says something that's way different. It's like, okay, you guys work for the same guy.
You're in theoretically the same meetings.
Yeah. Can we get a consistent message?
Yeah, there's not many of you. You're all on the same conference calls and emails. Just guys.
But I'm excited for this meeting just because I'm not excited for anything anymore. But
that's fair. I'm only excited for one thing. That's the new episode of Drunkenomics every week.
Yeah. I mean, even then, the only thing I'm excited about is the filling and killing. So
I didn't say what about the episode excites me.
It's true. Also, you did not mention that. But yeah, I just think, I don't know. I think the Fed is going to attack the inflation thing first because they have to. But
they do.
I also think they're still caught between a rock and a rock, or a hard place and a hard place, because if they raise rates, if they pull back, if they shrink the balance sheet, it's not going to help the supply chain issues, which is still not going to help inflation. But I do think, if you take cash out of the economy, eventually people are going to be like, I can't pay for that. And if I can't pay for that, the price of that thing will fall, no matter what it is.
And to be fair, that's not inherently a bad thing. Because the other issue is that you've got people who are like buying something, and as you get inflation, it's suddenly someone's like, I can't believe I can't afford whatever this is. Like, oh man, my utility bill just, if you're on natural gas for everything, your utility bill in theory doubles.
Yeah,
based on the cost of natural gas.
From
so you're sitting here like,
wait,
what?
Food prices, commodity prices, like the thing is, we have to pay for that. So like, if food prices are up, energy prices are up, rent is up, obviously rent's up, real estate's up, like all that stuff is up. Can you still pay for that used car that you wanted to get, or are you going to, kind of stick it out with this current car that you have?
Yeah, the answer, unfortunately, is usually no.
Right. Yeah. Or if you wanted to buy a new gaming system or new whatever it is, like, are you actually?
So while the used car doesn't get counted for GDP purposes when you buy it, like when it's being resold, anything else you might be buying where you're the end user or anticipated to be the end user, that is counted. So like suddenly you're not buying. Suddenly you're buying less food. So that's consumption is now decreasing in this country because you can't afford to buy as much as you used to be able to. Your durable goods.
Yeah, or just eating out less because, guess what? The restaurant that you're eating at, they had to pay more for that cow. So, that is now a steak. So, let alone your home cooked steaks are. Yeah.
So inflation creates this very serious problem if you start to price people out of the market. And you combat that event, in theory, you can combat that in such a way that it would prices employers out of being able to employ people in the market.
Oh yeah, there's wage inflation
or out of being able to expand.
Yeah,
and that's where you run into the issue where it's look, you can decide. You jump in a pool, you jump in a lake, you're wet either way, right? It just take your pick,
right? But basically, small businesses like right now, small businesses can't afford to employ workers because the cost of labor is just so expensive now, which is not necessarily a bad thing. I'm not saying it's a bad thing.
And this is another thing, looking at like a lot of workers out there, if you're expecting to retain talent, to retain your staff, you have to come up with money for them. Like, so if you're not matching inflation with your raises, you're cutting your employees' buying power, and they will leave.
Yeah,
they have to. They can't afford. We're at a point now where we can't afford not to.
Yeah, like they can't afford to spend their time making not as much money. So they have to find that thing that makes them enough money.
That's going to increase their buying power, or and not even increase it, at least maintain the buying power.
Right.
Because the one thing people can't have, especially in the United States, the one thing most people can't afford is to lose buying power.
Right. So, what do you think, though? So, like, do you think the Fed should do kind of the same old thing that Volcker did back in the 80s, is just, go head on and attack inflation, get inflation taken care of, and then from there, look around and start solving other issues?
I think they have to. I think we've identified at this point that the issue right now is that inflation has been out of control for 2 years.
Yeah.
And the reason, because there's multiple reasons you can run into stagflation. There's multiple reasons you can have this kind of thing. And so like the big one is like the supply side theory, or the supply side aspect to it, which essentially supply side says inflation is what drives it. Inflation is what creates
stagflation. So basically it's saying
both sides say it.
It's caused by inflation first. So inflation causes
inflation is the primary cause.
Oh,
now there's the supply side theory, which says that there's just too much money out there, and there's the demand side. There's the supply side. There's supply push, demand pull. And supply push says there's just too much money, and demand pull just says people just are buying. There's just so much demand for product that you see prices just shoot up in a way that isn't sustainable, right? And
I have a tough time deciding which one that is, because I think it's the demand pull.
The other aspect, I guess, because there's, when I say like supply side, so there's the supply side argument that there's too much money out there, too much money supply, which generally we could argue is demand pull. But another one, the other aspect of supply side is if there's just not enough goods, right? Prices go up again on that because supply is restricted.
Not enough goods, also not enough laborers, right? Which I think this is right now. It's a lot of. There's not enough labor at the current price. So when supply side drives that, right? So first of all, minimum wage is now all of a sudden, or if the average wage an hour now is $25 an hour, a lot of businesses can't afford to do that.
No,
right?
And what'll be really interesting is to a lot of people will be if that's where we end up, is it will be next year, come tax season. Because you've got now people who are making substantially more money, and so they've bumped into another tax bracket. And so when they go to pay their income tax, suddenly it's, whoa, what happened?
Because $25 an hour is what, $50,000 a year? Almost around roughly $50,000 a year if you work 40 hours a week, right? Maybe just shy of it, maybe a little bit over. I have no idea. It's around that ballpark. But Yeah, I think, $25 an hour, a lot of businesses, like small businesses, certainly can't afford to do that. No. So now we have a lot of people going to work at places like Amazon, Starbucks, the places that can afford to pay $25 an hour. Their buying power is actually increasing because they probably went from $15 an hour to $25 an hour now. So it's good for them. That's creating inflation in that aspect because of wage inflation, which kind of creeps into other sectors of inflation, if you will. I have no idea how you.
Oh, it absolutely does. Yeah, no, because when people have more money and they have a higher marginal propensity to spend, right? So
well, if rent is $1,500 a month, it's like, okay, I want to work. I need to work because I need to pay $1,500 a month in rent. And so-and-so small business is only paying $8 an hour. I can't afford to live in a $1,500 a month apartment for that price, for that wage.
I might as well just get a cot and put it up at the back of the small business because the only way to afford the $1,500 is to never leave.
Yeah, or go work at Amazon, which is, like, I think that's what a lot of people are doing, like, they pay you $25 an hour. So I think eventually, we all know what happens. Right.
Yeah, no. Well, eventually the economy is a game of musical chairs.
Absolutely.
It always has been. And it's just, if you speed the music up too much, then when you finally stop the music, people are moving so fast that when they dive for safety, it's much more drastic. More people get hurt.
Yeah.
Whereas it's the same if you're playing music that's so slow that people are barely moving, then it's kind of a dull game and no one's having right. So it's the entire premise of the Federal Reserve is to keep economic growth at a steady rate. So you don't want things too fast. You don't want things too slow.
What they say is most efficient. They want efficient employment and efficient economic growth.
Yes,
which
just they want sustainable,
whatever.
You're right. It's they want this.
Yeah, but I don't know. I do think that the Fed needs to attack inflation, like, first and foremost. But I just don't think it necessarily solves the supply chain issues, which is why inflation exists. I don't know. I'm glad this is not something that I have to do. Like, I'm glad this is not my job description. Is to solve supply chain issues and inflation at the same time.
Well, that's the next issue, is that to solve the supply chain issues, will that affect inflation? Yes. The problem is neither interest rates, decreasing them, holding them low isn't going to solve the supply chain issue. And raising them isn't going to help the supply chain issue. So it's one of those things where it's like, no, while at the same time as you, for the vast majority of the economy, are raising rates, you also need to target the supply chain and go, all right, what can we do to get this working properly?
Right.
If you're in a very serious car accident, there's a reason that when you get to the emergency room, you're seeing more than a single physician. There's different ones going, okay, well, we're worried about this.
You get an ENT guy.
You got these guys who are like, we're worried about these very specific issues. Yeah. And we understand we have to keep the heart pumping.
Yeah.
And then we got to worry about, the brain and other things. Okay,
all
we
these
got to worry about
different
bleeding.
fields of medicine that go in there.
But so the plastic surgeon might be the last guy who's,
right, exactly.
He's there, but he might be the last guy you're worried about hearing from.
Yeah, it's just like, okay, we'll fix that cave in your sheath. But I think it's still, like, at the end of the day, like, how do you solve a supply chain issue? Same way you solve any other issue. You throw money at it.
You figure out exactly. You look at it. You go, where? What's the issue? Like, what is the issue? Okay, why?
Right.
Is the issue that the Chinese factories aren't producing because Xi Jinping is approaching COVID like a war instead of like a?
I agree. He's very
triage.
He's very sensitive around COVID. I get it.
Because if the issue is that China's not sending you stuff, there's nothing you can do here to fix that.
No.
Really, you can try to source from somewhere else, but as a whole, no amount of truck drivers is going to fix the fact that there's no product showing up in ports. But if the products are showing up at the ports, then it's like, okay, well, it's getting here, it's getting on the trains, it's getting to the hubs. But it sits there, so we need more truck drivers.
Right, but all I'm saying is I still think at the end of the day, what we end up doing to fix any issue that we ever have is we throw money at it.
Absolutely.
Because history repeats itself. That's what we've always done. I feel like that's what we always will do. And, honestly, like, let's see what happens. I mean, I'm not a huge fan of the way the Federal Reserve spends their money, but, like, what else are we going to do?
To be fair, I'm not always a fan of how the federal government spends.
No, I've never been.
money.
I've almost like 90% of the time, I'm not a fan of the way the federal. 90%. Yeah, that's a good.
But I guess really,
number.
if you want to just throw money at things.
Yeah, if you want to just throw money at things, nice. I guess what you can throw money at is a nice black hoodie. Is that what you're saying?
I was absolutely going to say that. I was going to suggest you two could be as drunkenomical as Aaron and myself. You two could be out there and proud, showing off your drinkonomist nature, your econoholic background, and just show the entire show everyone that you meet that you are a huge Drunkenomics fan, or even a medium Drunkenomics fan, or an extra large Drunkenomics fan.
Yeah, whatever. We got all the sizes. We got all the colors, especially black, light black.
Absolutely.
More importantly, darker and even darker black.
That's absolutely true. So check us out at drunkenomics.myspreadshop.com.
That's what it is.
And you too could
fly as hell.
Every bit as good as us, and
probably better. Let's be honest. But yeah,
I'll be honest. Yeah, we got voices for the silent pictures and faces for radio.
Yeah.
So,
but yeah, from there you can also help us keep the liquor cabinet stocked.
It's getting harder now than ever with corn hitting all-time highs.
Yeah, and wheat and everything else. But if you find it in your heart, just spare a couple pennies for us. We'd really appreciate it. You can find us at Patreon, patreon.com/Drunkenomics, DRUNKENOMICS. That's where you can just help us.
Well, like I said, you nailed it. The liquor cabinet stocked, the ice frozen, and I'll be honest, the lights on and the mic's recording. So
exactly,
kind of place for everything there.
Yeah. So I guess with that said, appreciate you filling and killing with us. Hopefully your drinks were nice and cold as well. Unless it's one of those drinks that you
nice
need
and warm if you're in a cold spot. It's cold and rainy here in Lincoln today, so part of me is like, I'll do a hot toddy, and then I didn't do that. I had a tequila instead that warmed me.
Oh wow, nice.
Inside out.
I can't believe you had a tequila when it was raining outside. But either way, I'm glad you filled and killed. Glad you played chestnut checkers.
But for the rest of our listeners out there who, it is one of those drinking weeks, so just like St. Patrick's Day, by the time you hear this, you're probably going to be going into, you're in the U.S., some sort of Cinco de Mayo party. It's just another excuse for most people in the U.S. to go out, drink tequila, and get stupid. So don't be that guy. Be the Drunkenomical guy out there.
Yeah, and stay Drunkenomical, my friends.
Cheers.
Cheers.